Stocks like Homedepot and Lowe's have been successful compounders, but they're usually trading at a fairly good valuation. So maybe it's time to look at other areas of the world and see where their compounders are, where their home improvement stores are. And here we have one of the biggest competitors in the European market, Hornbach. It's a fairly small company, only 1.35 billion in market cap, but what makes it so interesting, the stock has not really moved since 2015. It had a great high in 2022, since then it's kinda come crashed down though, but the business has developed fantastically. And usually this is one of the times where I'm willing to look into a stock, when the stock has not moved for a very long period of time, but the business has developed great. You can see they had constantly growing revenue. Of course, since 2022 they had a bit of a slowdown in revenue growth because of the heightened interest rates. Home improvement, a lot of people take on loans for that, at least for very big projects. Or if just the economy is not performing as well, money is tight, you're not gonna remodel your kitchen or something like that. But we can see in normal economic environments, they have performed very, very well. They operate in several different countries in Europe. Germany is their main market, of course. Austria, Czechia, Luxembourg, Netherlands, Romania. Same-store sales in most countries have slightly shrinking due to the increased interest rates. But now, that interest rates are slowly coming down, we can see their same-store sales are improving again, back to very good growth numbers. We can see their non-German segment is growing faster than the German segment. They also have a small segment which is the Baustoffunion, which is other building materials like sand, etc., which you can buy there in great numbers. But their main business comes from the stores. As we can see, only 6% of their revenue comes from those building materials. And it's not like they're gonna have no way to grow. In many of these countries, they're not that present. For example, Germany, market share of 15%. Switzerland, market share of 15%. Austria, market share of 17%. They still have a lot of room to grow, even without the underlying economies growing that much. Plus, they're also winning in e-commerce. Their e-commerce business is fastly growing. And something like this is more resilient towards Amazon. Because for those type of things, you often need more professional help. And professional help you're gonna get at the Hornbach do-it-yourself store. I heard that in America, a lot of employees in those home improvement stores, they don't really know what they're doing. That is different here. They have specialists here. So there's also a big moat they have. And also this company has something I love when I see. Operating cash flow fastly growing. Meanwhile, capex staying fairly stable. And now what happens when that's the case? Gigantic growing free cash flow. Now that is the question, what are they currently doing with this free cash flow? Now, of course, they're paying around their 3% dividend. Not a lot. Only 38 million of that free cash flow goes towards dividends. But we can already see that means they can vastly increase that dividend. They're not buying back shares right now. Well, we're gonna come back to that. They technically are. But mostly right now, debt repayment. They took on quite a bit of debt to grow, but they're now fastly paying that back, and they're very successful at that. Since 2022, they paid around 400 million in net debt down. And with a market cap of 1.3 billion, you can just imagine what would happen if they would have put that money into share buybacks or paid us a dividend. So it is wrong to just look at this 3% dividend and say, this is all I'm gonna get, plus the underlying growth. No. There's a lot of capacity with a free cash flow, which the management can utilize once debt is at more acceptable levels. And while it's technically true, they didn't buy back any shares. Share count has been relatively stable. Technically, they did buy back shares. For that, we need to look at how this company is structured. They have the Hornbach Holding, and then you have Hornbach Baumarkt, which is the self-improvement stores. This used to be its own publicly listed company, and they only owned around 75% of it. They currently own 93%. They delisted this company and bought back most of the shares. That was around 180 million euros they spent. That would be more than a 10% buyback ratio. When we can see the minority interest in the company has greatly decreased since then. So this company technically bought back shares. It has the cash flow to pay out to shareholders. It has the cash flow to reduce debt, and it has the cash flow to grow. They're still opening new stores, but currently they're more focused on bringing back debt to an acceptable level. They're not very highly leveraged. $1.2 billion on debt to around 300 million free cash flow is 4 times debt. That is not a lot. Matter of fact, around half of their debt is long-term leases, so that is even less problematic, this amount of debt. And they are creating shareholder value with that free cash flow. They're not burning that down. Tangible book value. Tangible. Not something like goodwill, which AT&T has on its book, which is nothing. They have a tangible book value of 118 euros per share. They're trading at 85. So even if you were to completely scrap the company, sell off all the inventory, sell off all the real estate, pay down all debt, and then pay out all the money to shareholders, you would still make a great return. This is why I like this company so much. In Europe, the self-improvement stores are not very concentrated like in the US, where you basically have Lowe's and Homedepot, and that's it. In Europe, that's not the case. Hornbach has a lot of room to grow, and they have shown that they can grow. This is not a new company. They have grown for some time. And when a company like this, a great compounder, which grows revenues, grows free cash flows, pays down debt, pays you a nice dividend in the meantime, hasn't moved since 2014, then you know that this is probably a company you should look at, especially when it's trading at 4 times free cash flow. And what I can also imagine happening, with a market cap at only 1.3 billion, this is a great acquisition target. Imagine that Homedepot or Lowe's want to enter the European market. 1.3 billion is nothing for them. They can easily pay that out. I'm not saying it's happening, I'm just saying there are a lot of ways where you could profit from this investment. Now, currently they make around 18 euros in free cash flow per share. Let's just assume slight pullback to 15 euros. Historically, they have grown revenue by 7%, meanwhile they have grown their free cash flow margin, but we want to be conservative. Let's say 5% free cash flow growth for the next 5 years and 4% after that. That includes no potential buybacks, not even the buybacks they did before where they bought back part of a business, a huge decline in revenue growth or in margin. So I think this is very unrealistic, but just to be very conservative. Terminal multiple of 13, 20% payout ratio with little deduction due to taxes. They will probably increase this, but still, let's be conservative. Let's say they keep the current payout ratio. It turns a value of $133 a share. 57% discount. This is why I like the stock. This is why I'm adding it. This is why I'm building up a position. It is cheap, good growth, even with very low estimates. Now what if it goes better? We go to the historic performance. This is just the historic performance of around 7 to 8%. Nothing else. The free cash flow doesn't get paid out extra or you buy back more shares. In that case, 180 euros a share. Now what if it goes very bad? Only 4% revenue growth for the next 5 years and 3% after that and only a 10 multiple. That's tobacco multiples right there. Well, even in that case, we still make over 10%. So this is why I'm buying the stock. I think it's a great compounder. They're now paying down debt, and once the debt is paid down, they are able to either pay out more or grow faster. So I'm happy to add to the stock at these current levels. Let me know what you think, write it down below. Have a good day.